Hello guys, today I'm going to show you a useful tool that can increase your chances of profitability in trading. So let's just straight jump in and let's go on the 30-minute chart to find our New York Stock Exchange open, and this one is looking okay. Let's find a previous day high just for the reference, and here we have one. And now to understand this tool you need to understand some basic market mechanics of order flow or order flow footprint chart, as whatever you want to call it. Let's just quickly make a table right here. Okay, so right now we have what is called a book, and you can imagine this as some sort of price level, and those are basically contracts, and those numbers represent a sell limits and those ones represent a buy limits. So those are the resting orders, and in order to fill those orders there have to be aggressive market participants. So let's say there is a buyer that wants to buy 15 contracts, and he will buy at the best ask price right here, and those 50 contracts will move right here onto this order book. 15 contracts will disappear from here and they will be written in the book. And then you have aggressive seller that wants to sell the market. He will be executed at a best bid price, which is right here, and he wants to buy 15 contracts. That means that those 10 contracts will be deleted and will be written in a book. Another 5 contracts will be erased from here and will be written in a book. So what this represents is an order book, which is a book that writes all of the orders in the market. And we also have a tool on the TradingView for this called a fixed range volume profile, which is not directly correlated to the order flow footprint chart because you have to use it manually. It won't draw automatically, but it is still a great tool to use if you know how to use it. So this is a previous day high, and right here is what most people would call this a liquidity sweep, because let's say people started selling at this price and they put a stop loss order right here and they take profit somewhere here, and let's say take profit did not get hit. Okay, so we have been told this is called a stop loss, which is kind of true but partially, because you have to understand when you are selling the market, you are actually borrowing your shares or assets to somebody else in hope of price declining in some amount of time. And when price declines to your preferred level, then you will buy back the assets or shares that you have borrowed to the other participant, which means if the price of that asset lowers, you will actually have more of those assets for the same price. Why? Because of course price has decreased over time. Let's say vice versa, price instead of declining has inclined, and therefore you buy those borrowed assets back but at a higher price, which means that you actually lose money because now you actually have less of those assets. But what you have set up right here is not a stop loss, it is actually a buy stop. And what happens is that when you sell your assets or borrow your assets to somebody else, at some point you buy them back, which means that you are actually a part of aggressive buyer participants in the market. So you are basically a aggressive liquidity. The role of the aggressive participants in the market is to move the price to reach the sell limit or buy limit orders, which are mostly set by the banks or financial institutions. And those financial institutions always mostly like to place their limit orders above all highs and lows. This is why when price has to push above high or above low, we call this a liquidity sweep. But what happens is buyers, in this case aggressive buyers, are pushing the price up in order to fill a sell limit order. Let's say theoretically there's a sell limit order set by a bank because they want to fill that order. And what happens right before filling this order is an aggression steps into the market. And there is a special tool in the TradingView that can help you analyze how much buying aggression or selling aggression there is. So there's something called fixed range volume profile, and let's scale down to 5-minute chart just for a more detailed view. So right here, let's say this is the old high that we marked earlier, and let's put some fixed range volume profiles on the singular candles, just on the first 3 before sweeping it. Right here you can see as price inclines, the numbers in the fixed range volume profile are starting to get bigger. So this volume profile is set onto delta mode on ticks per row, and what it tells you is what we have talked earlier about. So when an aggressive buyer wants to buy contracts, that means that somebody has to sell him that contracts. And buyers, of course, won't buy from an aggressive sellers, but rather from a passive seller, which means that they have to fill out a sell limit order. So in this case, this correlates to what we have been talking about earlier. So let's say a bank has placed their sell limit order. Buyers, of course, their role is to fill out this order. So they push the market up, and you can see here's 1.34k contracts and 1.424k contract being exchanged at this level, which means this is a highly liquid level. This is why people refer to this as a liquidity sweep, but professionals call this sweeping the book, because you actually sweep what we have showed earlier, the resting orders, in this case sell limit orders. And when buyers fill this order, you want to look for an opposite market aggression, which means that sellers have to step into the market in order to fulfill the need of the bank. So if the bank wants to sell a share at a certain price, then the sellers will have to start pushing down in order for the bank to be in the profit. How you can use this in your advantage, you can look at the numbers, and if the aggression is very high, as you can see 1.14k, 1.07k, 900 contracts being exchanged, you can actually step into this market, but of course you'll have to use other confluences that are mixed in your strategy. So you want to focus on this model alone. This is just a pivot point that can help you be more objective when entering the market. Because in trading alone, your accuracy cannot always be 100%, okay? You will lose sometimes. And this tool will not increase your accuracy, but it will increase your knowledge about the market, because it will actually show you where there are big orders being placed, so you can actually follow the orders of those banks and institutions. Please remember, that does not mean that banks or institutions are hard hunting for your stop loss, because as we've said earlier, when you have a stop loss after selling the market, which means this is actually a buy stop order, you are actually a participant of the buy market aggression. So after this, we can see price declining a lot. When price reaches a certain level, it will most likely reverse or not. But in this case, as you can see, we have another low right here. And if you take a closer look, a price fell beyond this low. Let's see if there are any big aggressions, selling aggressions, in order to fulfill anything that is below this level. You can see there's a lot of red numbers, but there is not more than 1,000 contracts being exchanged per tick. So there is still some aggression in the market, but not that much. Because you can see it is 2 p.m. and price at this time, of course, is not very volatile. So this was just a quick recap on how powerful this free tool in TradingView actually is, so fixed range volume profile, and how you can use it into your advantage. So please do not just solely base your strategy off of liquidity sweep and some fair value gap, because this is like trading with a blindfold around your eyes. In the trading industry, you cannot be subjective, because I have never heard of a person in the New York Stock Exchange trading with fair value gaps or order blocks or equilibriums or any of those ICT concepts. You have to be objective and actually look what is going on behind all those candles in order to achieve a bigger win rate or profitability, or maybe even accuracy. So this will be it for this video, and I hope you found it useful. And again, you have to backtest those concepts yourself, so do not just rely on my tutorial. I will try to make some more videos like this, explaining like any complex concepts about the market. So please subscribe, and I will see you in the next video. Thank you.